Rachel Griffith has researched corporate tax and how it affects firms' decisions, particularly in a globalized world.
There's two real questions. How do we want to tax corporate profits? And what are we trying to achieve when we tax corporate profits? And then the second thing is, who should get to tax them? And in a global world, that becomes complicated.
While a tax system needs to be fair, it's the fairness of the tax system as a whole that matters, according to Griffith, and measuring that involves an important set of questions and a clear definition of some key terms.
Corporate taxes play a very important role in ensuring that we collect labor taxes, because otherwise we would all just be companies, not workers. But whether they really are an effective way of taxing rich people is unclear, and actually is something in economics that we have relatively poor understanding of. It all comes down to the incidence of the tax. When we put a tax on corporate income, is it the shareholders that are made worse off by that? Or does the firm kind of shift that onto workers and lower wages, or onto consumers and higher prices? The kind of best evidence we have now suggests that maybe about a third of it is shifted on, and then 2/3 of it fall onto shareholders. We need to be a little careful there because shareholders aren't all rich people. So in the UK, for example, a very substantial number of shares are held by pension funds. People who have pensions aren't the poorest people in society, but some of them are certainly not the richest either.
Economists and policymakers alike must also consider what will be beneficial to consumers and individual countries long term.
Corporate taxes are a pretty inefficient tax in that it has a big effect on the incentives for firms to invest, and investment is an important source of growth in the future. And so if we can raise tax revenue from other taxes that are less distortionary, then we may want to do that. Say we did want to tax corporate income. Most companies now operate globally. So who has the right to tax that income? The principle we have in international taxation at the moment is the country that gets to tax the income is the country in which the value that the firm generates is created. Who has the right to tax a company, and how much do they get to tax them?
It is precisely questions such as these that become very difficult to answer when companies operate internationally, or when looking at tech companies whose assets and value may be less concrete.
Much of the debate in corporate tax internationally is that the US operates a set of tax laws that allows US corporations to pay very little tax in the world. But that's because the US has decided to do that. And if those are US companies, does the US have the right to do that? Or does Europe have some say in how those companies are taxed? It's the forefront of that where the real tension lies. The principle that you tax companies where the value is created doesn't make that much sense when you have businesses that are based on intangible assets and operate globally. I give seminars around the world in different countries. If you want to say my papers were worth something and they earned income and you wanted to tax them, half the time I'm working in an airplane that's flying between the US and the UK. Who has the right to tax that? The value's in my head, and my head moves all around the place. You know, is that the UK? Is it the US if I have that idea when I'm in the US? The current tax rules we have don't really fit that system very well. And what we really need is a complete rethink of the system such that it works better with firms like that. So a lot of that is around the politics of it rather than the economics of it, yeah.